Welcome to the second Adapa Advisory webinar. Today's webinar is on the subject of digital assets, and I'm delighted to be joined by Paul Maley, who's the Head of Global Securities Services at Deutsche Bank, as well as the Head of the Corporate Bank for the UK and Ireland, and also Maxime De Guillebon, who's the CEO of Zodia, the digital asset custody provider that particularly focuses on cryptocurrencies. Paul and Max, thank you very much for joining, and look forward to a lively discussion on a very topical subject. So diving straight into it, if I may, what are the drivers for institutional investment in digital assets, and what assets do you believe are attracting the most interest at this point? And Max, can I go to you first?
Sure. So I think what we're seeing, and this has been an evolving trend over the past couple of years, because we started our, I'd say, crypto journey back in late 2017, early 2018 as part of the Standard Chartered Group. And what we're seeing really is client demand. Client demand has been by far the biggest driver. Now it's relatively easy to say client demand. That sounds very obvious. So, but realistically speaking, it's the underlying investor in whatever vehicles that funds or asset managers tend to propose that are requesting exposure to this new asset class. And I think you can probably break it down into three sort of categories when it comes to why is there such demand and such client demand driving this. I think the first one is pretty obvious, is the price of Bitcoin, and more often than not, cryptocurrencies are associated with Bitcoin first, although you have thousands of crypto, but realistically speaking, Bitcoin is what's representing cryptocurrencies, and the interest has been following the price of Bitcoin. So back in 2017, you had Bitcoin at 17,000. We had an outburst of queries, interest on, wow, that's coming up. Can you, what are you doing about it? And are you offering any services? And then it's gone back down to 4,000. I think people call it the crypto winter. And then nobody heard about Bitcoin for maybe 18 months until December of 2020, where it became very popular again, because it went from 8,000-9,000 to 50, 55, 60,000. And all of a sudden that was again the hottest asset in the market. So there is a very, very strong correlation between client demand or queries and the price of Bitcoin specifically, not so much with the others. Along with the price of Bitcoin, I think what's also very interesting is the press that crypto have received, for the right or the wrong reasons. Started with private stablecoins. So when Facebook announced its project, it was cryptocurrencies was an unavoidable topic at board meetings, I suppose, of every financial institution, every asset manager. And the fact that you have crypto a lot more in the news means it's a lot more accepted, and it's essentially not an asset you can ignore anymore. And the third piece, I would say it's FOMO. When you're an asset manager and you see that other firms are playing with this new asset class, you are under a lot of pressure, and this is what we're seeing as well from a custody perspective. That if your peers are offering crypto assets in one way or the other, or exposure to the underlying directly or indirectly, you have to be seen in doing something in that space as well. It's true for asset owner, it's true for asset manager, and it's also true for service provider. So I would say these three elements are really driving the overall client demand for crypto, which is pushing most of asset managers to offer this, get exposure, create products around crypto assets.
Max, I think your summary was right on. I mean, it's also partially driven by the overall inflation in asset prices, right, of other categories. And even though the allocation from institutional investors is still relatively small, right, on a conventional sense, maybe 2 or 3%, right, it's going to be part of the alternative assets mandates that those investors have. They definitely don't want their exposure to be zero, because that is something where their own clients and their own investors now have an expectation that there's some exposure there. But it's also an attractive class, right, because of the perceived lack of correlation, right, to equities and fixed income, right. So it's it's put alongside the phrase that always seems to come up, of course, is digital gold, right, when people refer to Ethereum and Bitcoin. And I don't think that's a bad analogy.
And guys, I guess the thing I'm conscious of when I first started to get involved in this space, the institutional investors, interestingly, they didn't see it as a diversification play 18 months ago. They saw considerable risk associated with it. There was concerns about regulation. And as you've both said, that's changed dramatically in this last 18-month period. Clearly, aspects of that are still relevant, but the interest and the demand is clearly there, also driven by their wealth and broader asset owner customers. But kind of just as a segue from that, how would you kind of define the risk appetite of institutional investors, and how is that impacting the investment approach that they're taking for themselves and on behalf of their clients? And what I mean by that is it resulting in them directly investing in these products, or are they more likely to look at ETFs and other structured type products to offer their underlying clients? Max, maybe to you first.
Yeah, so maybe before I answer that, I think it's important to understand who started to look at crypto and who is looking at crypto today. So, and again, back in 2017, only crypto hedge funds were involved in crypto assets. And I do remember that Standard Chartered Research published a paper on crypto in, I think, April 2018, and I should have that one framed in my office, which is cryptocurrency can't touch this. That was, again, 2018. And I think that was broadly the sentiment of most of the market participants. Forget about regulated financial institution. I think that was generally the market sentiment. What we're seeing is from crypto funds, the crypto native kind of, asset managers, we're now moving to, hedge funds, household asset managers, retail brokers, commercial banks, global custodians. We haven't seen pension funds getting into crypto yet, but I reckon that's going to be the trend in 2022. That when the pension funds start to get exposure to crypto, that you've gone through the full life cycle. And that's now, I would say, an established asset class, which is covered by our clients. But that evolution from crypto native to where we are today, with most global custodian, with most asset managers looking at taking exposure, I think that's a very, very interesting trend, and that's really telling about the true adoption of crypto. From an institutional side, which is really where we focus on at Zodia, first of all, what we saw is the grayscale type products, which is you invest in a trust, and the trust then invests in crypto, but you don't have direct exposure to crypto. The next step is you invest in a fund that invests in companies who have crypto-related businesses, and I know there is quite a few funds that provide exposure to companies as opposed to the underlying. And then you move into futures, right? So the CME has been very popular because it's all cash settled. You get exposure without really touching the underlying. The next stage, and this is where the regulatory environment kicks in, is do you go for an ETF type product or ETN type product, or do you get access to crypto directly? And the reality is, depending on where the regulator sits, you may be able to use an ETF structure or ETN structure, or you may actually want to get access to the underlying, the BTC, the ETH, and every single underlying crypto. And I think right now there is a bit of a 50-50 on how do I get exposure, but clearly exposure is getting much closer to the underlying than before. And I think the appetite has moved, and people are potentially considering holding their own crypto assets as opposed to, I would say, a traditional securities, which would be backed very much like a gold-backed product. And I think you mentioned gold earlier on, but a crypto-backed product, but again in a securities forms, trading in the traditional markets, if that makes any sense. There are limitations though, and I think your earlier point around which crypto assets are the most popular. If you look at the ETNs, they're generally around BTC only, Bitcoin only. But the reality is we're seeing demand for other type of currencies. So Bitcoin and ETH are probably 80% or 90% of what I would say institutional investors tend to go for, and that's your entry point. But I can guarantee that other cryptos such as Cardano, Solana, Polkadot, and the likes, and some crypto that haven't been created yet, but will be very popular. Exposure is much faster through, I would say, direct purchase of these crypto than through structured product that are relatively expensive to run, expensive to create, and again, follow the regulation. That's not always being sort of rolled out or implemented as fast as the demand is.
No, that's great, Max. And Paul, just given Deutsche's significant global reach and very strong institutional client base, I mean, what are you seeing in this space? I mean, what are your clients looking for? Are they giving indications of how they would like to get exposure to these assets? And obviously, we've kind of primarily talked about crypto so far, but are you seeing interest in potentially broader products like security tokens and such like? What's your perspective?
Oh, certainly. So, I mean, we have a very broad stakeholder community for this topic, right? And I'm sure that's not different to any of the other large banks as well, of course, including SCB. But we see demand from every single client sector. Both obviously institutions, including hedge funds and market makers, who may want to quote the underlying products as well as hold them. We see that through the type of clients that want to buy the products that Max was referring to earlier, be that through structures like ETFs and ETNs, which obviously give you that kind of wrapper that you can hold in a conventional structure with just providing delta one exposure to the underlying. Clients who actually, of course, want to trade the futures, which are now relatively liquid on the CME, or they actually want to be able to trade a non-deliverable forward, maybe using the futures as a hedge, and that includes obviously our wealth management clients and our asset management division. So the demand is everywhere. It's genuinely consistent. The products that obviously the firm wants to provide depends on the buying segment of the clients, and that will be appropriate and suitable in each case. But the level of interest and the level of demand from every single client sector is really, really strong. So I think, as Max said actually at the beginning of the segment, this isn't going away. I'm actually surprised it's taken as long as it has. I mean, my first, kind of foray, I didn't even think I was a particularly, early adopter, but my first foray in looking into this topic, through my profession was 8 years ago. But it really, now kind of like, the end of 2020, signaled a really big change, I think, in the investor interest in crypto assets overall. And now the financial markets are adapting to meet that demand.
No, that's great. And I guess when you consider the crypto market is now in the order of 2.7 trillion from a scale point of view, obviously there's been significant progress with some volatility, as Max, you described at the outset. So as from a business point of view, Adapa Advisory focuses, as you know, on the post-trade and security services side of the industry. But I'd like to just shift the conversation into the custody space. And in that regard, what would be useful would be a headline of what is digital asset custody, and how does that differ from what we know of custody for traditional assets? And maybe, Max, you could just kind of start that question off and supplement it, Paul, as required.
Sure. So I would potentially think about it in two ways, right? If you think about custody with capital C, and by that I mean the way the UK CAS rule defined custody, as opposed to merely the security over private keys, but custody of crypto assets is no different from securities custody in a sense that as a custodian, your role is to safeguard clients' assets and make sure that you record the legal title properly. And I think really these two elements don't really change. What is fundamentally different here is how you achieve that.
And Paul, do you have the same perspective?
Yeah, I mean, I think, look, the service is clearly new, right? But that's also because not only the asset class is new, the technology on which it's based is new. So that's the differentiating piece. What clients are looking for, though, is like is a fully integrated solution. They want to have the same kind of standards, the same kind of services, the same kind of transparency, the same kind of connectivity that they would have for their stocks and bonds, for their digital assets as well. So I think part of the trick for making this a success is being able to offer an integrated service that works for clients who are obviously not going to have crypto as their primary nexus for investment. So they still want tax reporting, right? They still want asset servicing. They still want the fund administration services, right, that our industry provides. But they want that to include crypto. So the journey that we're all on, right, is to be able to provide that harmonious, interoperable service in a way that becomes easy to consume for our customers.
Do you see that most organizations will try and develop a capability of their own to support these assets? Or do you feel that rather like the traditional model of global custody and sub-custody, for example, that you would see these assets potentially being supported by a smaller number of specialist providers, akin to what we see from a sub-custody approach?
My personal view is that it'll be a hybrid. So there are clearly a really interesting, really diverse ecosystem of specialist providers out there that many of the banks are already working with to not only kind of explore this space, right, but now moving into that phase of building new products. And DB is on a similar journey to that, right? I think Max's business is a really interesting hybrid, right, by being having these major bank sponsors, right, but also being a specialist technology company at the same time. So there's no right and wrong way to do those things. However, I think every bank will need to have an in-house competency, right, that's able to work with crypto assets and distributed ledgers so that you can get the interoperability correct, right, between your existing technology stack, which obviously clearly is not going to be distributed, and this new set of services that clients want to be able to use in a relatively seamless manner. So it will probably begin looking slightly bifurcated, right, in terms of how the technology is deployed. But I think over time, right, it will become much more integrated, and we'll have a much more seamless customer experience. So I don't think there's a standard playbook for this. I think every firm is going to do it in their own way.
I will disagree with you, Paul. And I said I would, so here is my time, right? So I think it's probably misleading to reduce, and this is what I was trying to say earlier, Mark, to your question on what is custody. And there is custody with a capital C. and sort of custody from a technology standpoint. And I think, Paul, you're absolutely right. If you look at a technology solution to handle private keys, then I absolutely agree 100% with you. All right? You can get a technology very much like you get your core banking system or whatever else to manage payments, to manage NAV calculation, etc. You just get a technology and then you integrate that technology within your tech stack, right? Absolutely, that's probably is one way of doing it. And then you have custody with a capital C, which is the service you're providing to your client being a global custodian in a sub-custody model, or being your underlying asset owner, asset managers. And what I call qualified custody or custody with capital C is a lot more than just technology. And I think this is really where, and again, now I can reflect on my own journey within the group. Where did we spend most of the time? Did we spend most of the time defining the technology to be used, HSM versus MPCs versus hot wallet, etc.? Or did we spend a lot of time defining the legal structure to ensure insolvency remoteness, to look at events such as forks, airdrops, account closure, to look at financial crime compliance, how do we mitigate these risks, to look at governance of crypto assets, to look at the regulation, to look at the fact that cryptos are 24/7, and I can probably guarantee that none of the systems in banks today function 24/7. They have to stop. If you think about very simple things such as decimal places, when you have EAT, which has 18 decimal places, again, I can guarantee that none of the bank systems can handle none of the systems in general, forget about banks, can have these 18 decimal places. If you look at the concept of payment finality, again, from a legal structure, it's very different. So I think I agree with you from a technology standpoint. You can integrate a technology within a bank tech stack. The problem is everything you put around it. The problem is really your governance model, your risk management, your risk appetite, your policy, your standards, your DOI, how you manage your compliance and financial crime, what tools do you need to achieve what a regulated financial institution needs to meet in terms of standards. That again is completely different.
Oh no, Max, I completely see your point, but I think we are actually agreeing more than we're disagreeing. Because the point I was trying to make was that you actually can't compromise on any of those things, right? When you think about client asset protection, when you think about transaction monitoring, when you think about surveillance, when you think about KYC, when you think about all of the standards that, it's a very highly regulated environment in which we all operate. What the regulators will not accept, of course, is any compromise to the existing protections, right, that the markets and the financial system already has, whilst we introduce, right, this new technology and this new asset class. So I actually don't think we diverge too much on that actual point. I think what I was trying to describe is that the channel that gets there, right, between, for each financial institution, and of course the regulations and the treatment will be different or slightly different, in the jurisdictions around the world. We need to have some level of consistency, but we need to be able to be, flexible in the way in which we adapt to each individual market. So, in fact, one of the most difficult challenges is going to be that the very nature of being distributed, right? The fact that it is not clearly a jurisdictionally centric technology, right? It doesn't exist just in one place, makes it that much harder because laws and regulations get issued by governments. So yes, that's still, I think, something that the whole industry is struggling with.
In a way, don't you think that this will potentially prevent regulated firms like banks to actually play in that space and leave a lot of the opportunities to unregulated firms that will have a little bit more flexibility with crypto assets, while the framework for regulated firms will be a lot tougher a lot more difficult to navigate with these restrictions. And the reason why I'm asking is, we sit within the Standard Chartered Group. We are considered a subsidiary, but at the same time, we're trying to not impose, but drive the standards for crypto asset up. We're trying to do the right thing. We're trying to make sure, we push for regulation, we push for travel rule, we push for compliance, financial crime standards to increase a lot more in the crypto space. And sometimes we are not necessarily helped with the fact that there is a regulated world which gets more and more regulated, and then you have an unregulated world that continues to be unregulated, and that doesn't really create a level playing field. So just curious on your views around that, these kind of additional guidance for regulated firms, and whether that doesn't create this difference of standards across regulated versus unregulated firms.
Yeah, I think, look, I mean, there's clearly a really significant unregulated ecosystem, right, around this asset class that already exists. I do think, though, that one of the inevitable changes that will happen as the products become more mainstream, and, we've obviously mentioned, earlier in this webcast, like the breadth and depth of investor interest, which is coming into crypto, that it's almost inevitable that these tokens, these cryptographic coins, will be subjected to the same regulations that we recognise for other investment products right around the world. So I'd be very, very surprised if we end up with a bifurcated regulatory system, right, between an unregulated and a regulated collection of products. I think ultimately, investors, end users, retail customers, will expect over time, right, the same standards to apply. So we'll see how long it takes for those two trends to converge. But will they converge? I'm almost sure.
I've got a basic question which I'm going to develop subsequently. But just given the commentary that you've both given, this issue of bifurcation of capability, let's say the lack of common standards, differing rails in different jurisdictions, etc. What does an asset owner need to think about in terms of selecting a digital asset custodian at this point?
Number one is, how do you achieve asset safekeeping? So looking at legal contracts, omnibus versus segregated wallet, how does the technology work? How has security been embedded into the design of the product? The sort of understanding the cyber risk, which is, by the way, very difficult for traditional procurement team, network managers, because that's a brand new world to understand, and typically not many firms are equipped to understand the crypto risks, and therefore what needs to be put in front of them from a solution perspective. And again, the last piece around asset safekeeping is resolution mechanism. What happens if the custodian goes down? What happens if it disappears? Who has the keys? You don't really lose the assets, but ultimately you need to think about it in a sort of worst case scenario. The second very important point is market access. What coins do you support? Where do you access liquidity? How do you work with the ecosystem, custodian, OTC desks, exchanges, etc.? How do I do that in a compliant way? And in compliant way could or should now involve, travel rule compliance, making sure that you have an ecosystem where you're not going to be dealing with, I would say, dirty coins, dirty counterparties, or touch any of the sanctioned activities or transaction. Third element, I would say, financial strength or financial backing around your funding, who sits behind you. Is that a hobby? Do you provide custody because you had to, or is that generally your business, and how committed are you to building and maintaining that infrastructure. And for crypto, I think it's also important to look at the insurance, which is probably overlooked in traditional world. People look at balance sheet. The reality is for crypto, it's a little bit more complicated. So looking at proper insurance and understanding the insurance market is fundamental, whether it's a specie market to insuring the private key in a box, or you actually have more of a digital crime insurance covering any fraud on your platform. And last piece, obviously, again, maybe for asset managers that operate in a more regulated world or regulated products, is the governance, risk management, and how your custodian applies compliance and financial crime mechanism to prevent any sort of unlawful transaction from happening. And I think, Paul, you mentioned earlier, transaction monitoring, surveillance, fraud detection, screening, all of that, which, to be fair, is what a traditional financial institution does on a daily basis, and I've been doing for decades, really. But applying that to crypto, and I think it's very important to understand how a custodian manages these risks on behalf of the asset manager or the asset owner.
The only thing I would supplement with is just the point that I made earlier, which is the fact that clients want, that kind of, trade reporting, they want their tax reporting, they want something that looks similar to what they already have. We need to keep in mind, right back to the beginning of our conversation, is that most customers wanting to use these products want to use it as an alternative asset, right? As a sideline as to other business that they're doing. They're not going to be just a crypto consumer. And our job as an industry is to make it as easy for them as possible to access.
I think you're, and I missed that point, but I think you're absolutely spot on. And sometimes it's a little bit of a, we think about the world as crypto or non-crypto. And I think that's probably a very wrong way of looking at it, because I would agree it's just another asset in someone's portfolio. But ultimately, when it comes to reporting, when it comes to operation, when it comes to ideally even risk management through sub-custody model, none of the clients will change their processes, their policies, just to get a 1% of their portfolio that needs to be completely different. So building these bridges between crypto and traditional finance, from an operational perspective, very important. From a risk management perspective, very important. And I think, from a cross-asset sort of, leverage, so going back to the services of Prime, for example, collateral management, repo, and the likes, I don't think crypto is going to be any different. So making sure that your custody provider can work with other providers, financial institution, prime desks, fund administrator, trustees, etc., or understand that world at the very least. I think you're right, is equally important on how that interaction happens. Sorry. Thank you for highlighting that, because I think that's a true differentiator. We talked about the unregulated world, and I'm not sure the unregulated world understand that these bridges are extremely important.
And I think what you're both saying, is that this is going to evolve, where the client is going to want from crypto or any cryptographic asset, tokenized asset, they're going to want a level of service that is equivalent to custody, clearing, asset servicing, fund administration, the whole value chain that you would see for a traditional asset. I think what you're both saying is that that's the direction of travel here, because the client is going to need to recognize that asset in whichever part of the value chain it's going to appear. Is that a good summary, and would that define the direction of travel?
For us, it's very interesting when we look at product managers, right? So we look at what should be a custodian product. And you're right, there is an element of clearing, settlement, and the whole post-trade world, and how we integrate that with a global custodian, for example, a CCP, a CSD, and how that all works for crypto. On the other hand, you also have crypto-specific products or crypto-specific activities. So if you think about staking, for example, I'm not even going to go into the DeFi world, but if you look at staking, it's a very, very, it's like it's like saying, well, you can put your cash to work by processing payments on the SWIFT network, right? It doesn't exist. So there is an element of, yes, we need to make sure that crypto is embedded in the overall finance world, but there are also activities which are very specific to crypto. And sometimes the crypto industry has developed a parallel ecosystem, which is sometimes terrible, sometimes as good as a traditional, system, and sometimes a lot better, just because they start with a blank sheet of paper. So yes, to the fact that there is a reason why I would say post-trade world has been created in the way it is, with various actors and participants, etc. Bringing trust in the ecosystem or trusted counterparty. And absolutely, crypto needs to make sure that that can't be ignored, because that's what clients are expecting. We shouldn't close our eyes on what are the new processes or the new post-trade for digital asset, and potentially some good ideas that are being brought up. Just because that world is new and not necessarily built or designed by people who've known traditional finance. So they look at what's the most efficient, and then you have the very crypto-specific activities for which, to be fair, we'll have to build a little bit of a product and a little bit of an integration and a little bit of a world around this. And staking is just one of them. And I'm sure the world of NFTs and DeFi is completely new to most of us. So I think it'll take some time to understand how the two worlds merge in one way or the other. But I would think the principles will have to remain the same.
Max and Paul, we've looked at the investor landscape. We've looked at some of the fundamentals of digital asset custody. Can I just get your perspective on how service providers will approach the complexity of building a global solution?
If you look at the technology, the beauty, you have one platform, right? I mean, these digital assets don't really have a home or don't really have a jurisdiction. And that's great, and that's not great at the same time. So, for example, at Zodia, all our assets are considered to be on UK soil, because we can apply UK laws, and digital assets fall under the property under UK law, and that allows us to do a lot of things with crypto assets, such as insolvency awareness, creating bare trust, solving for collateral management and security packages, right? So that's actually a benefit to us in one way, and it's a benefit from a technology standpoint, because if you connect to the Bitcoin network or the Ethereum network or the Solana network, it's just one market, right? You don't need to connect to multiple places. The geographies the jurisdiction become irrelevant. Where it gets really, really difficult, and this is what we're experiencing today, is the treatment of these digital assets based on where your clients are located. And the rules are very unclear. You have countries that have banned it. You have countries that have put it under a Payment Service Act. You have countries that put it as a commodity, as a securities. And sometimes one asset is treated differently from one country to the other. So in one jurisdiction, you may be dealing with the securities, while on the other, you're dealing with the currency, and the third one with a commodity. And that makes the whole global offering a little bit more complex. There is also an added complexity when it comes to how the regulators are regulated that world. And if you take an example of the travel rule, so travel rule is the FATF paragraph 16 or section 16, which is the equivalent of payment transparency adapted to crypto, where the minute you send crypto assets, the remitter and the beneficiary needs to be identified, broadly speaking. The implementation of that guidance has not been the same if you're in Hong Kong, in Switzerland, in the US, or in the UK. So, for example, it's not the same type of data that you need to share between custodians. Sometimes you need to share, sometimes you don't need to share, sometimes certain types of wallet are excluded. From an implementation perspective, considering crypto is essentially borderless in a way that you trade with multiple counterparties cross-border, it becomes an absolute nightmare to understand to what extent you need to implement a particular regulation, because the two are typically conflicting. So the complexity really comes from the lack of harmonization across jurisdiction on the regulation on one hand, but that's, I would say, not necessarily something new. It's true today for securities, but more around cross-border settlement or cross-border transfers, which makes life really, really hard. And I think a lot of the resistance of, I would say, a traditional service provider is the lack of clarity on where to stand, especially when you have footprints in multiple geographies.
Yeah, no, it's actually one of the biggest challenges, right? And it's also one of the biggest challenges to how the market will be regulated. And as you mentioned, Max, right, the interpretation of those regulations in all of the different places where we do business. I mean, if I just use my own business as an illustration, right? I mean, we have a physical presence in more than 30 countries, right? We offer market access to nearly 80 different markets around the world. I mean, that just gives an idea of the actual, the actual spread of that to our clients, right? Around a similar number of countries. And this is a product that we want to be able to offer to all of them. So we've got a long journey as an industry that we'll have to go on to how we make this work at a practical level. And there will be certain jurisdictions. I happen to think that, Germany and the European Union are quite advanced on this particular topic, right? Because of the MiCA regulation that's already come in, specific crypto licenses in those countries. Obviously, Max has a business that's regulated by the FCA, so it won't move consistently at the same speed, right? In each place that we do business. So, having said all of that, it's one of the reasons why it's such an exciting place, to work right now, and why it's such a great change to be part of. So it'll certainly keep us inspired and entertained for the next few years. There's no doubt.
What I'd like to do is thank you, Paul, and yourself, Max. This has been an illuminating conversation. What I recognize is that we could have many of these conversations and still only be scratching the surface of some of the detail. But thank you ever so much for your cooperation, your insights, and I really appreciate you supporting this webinar. Many thanks, and have a good rest of the day.